quick note, this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Most traders never fail because they lack strategy. They fail because they cannot manage themselves. And this is where everything changes. You can have the best system in the world, the most refined entry model, the strongest macro framework, and still lose consistently if your psychology is not aligned with the realities of trading. This is not a motivational concept. This is a structural truth. Trading is one of the few professions where your internal state directly impacts your external performance in real time. There is no separation. Your decisions, your reactions, your patience, your discipline, all of it is exposed instantly in your results. Now this is critical. The market does not reward intelligence. It does not reward effort. It does not reward how much you want it. It rewards execution under uncertainty. And that is a psychological skill, not just a technical one. Most traders approach psychology as an afterthought. They focus on entries, indicators, strategies, and only when things start going wrong do they begin asking questions about discipline, emotions, or mindset. By then, damage has already been done. This video is designed to reverse that, to build your psychological framework first, so that everything else sits on a stable foundation. Because without that foundation, every system you use will eventually break down under pressure. Over the next sessions, you are going to understand how professional traders actually think, not what they say publicly, but how they operate internally, how they process risk, how they handle uncertainty, how they remain consistent in environments designed to trigger emotional reactions. And most importantly, you are going to learn how to build that same structure within yourself. Let's start by reframing something most traders misunderstand completely. Trading psychology is not about eliminating emotions. That is impossible. You are human. You will feel fear, greed, frustration, confidence, hesitation. These are natural responses to uncertainty and risk. The real objective is control, not elimination. This is where most traders get it wrong. They believe that professionals somehow feel nothing, that experienced traders operate without emotion. In reality, professionals feel everything. They have simply built systems to ensure those emotions do not dictate decisions. Think of it this way: emotion is information. Fear tells you there is perceived risk. Excitement tells you there is perceived opportunity. Frustration tells you expectations are not being met. None of these are inherently bad. The problem arises when they override structure. Professional traders operate with predefined rules that sit above emotion. When a decision needs to be made, they do not ask how they feel, they ask what the system requires. That distinction is everything. Now this is critical. If your decision-making process changes based on how you feel in the moment, you do not have a system, you have a reaction loop, and reaction loops lead to inconsistency. Consistency in trading does not come from being right, it comes from being stable. Stable in execution, stable in risk, stable in behavior. So as we go through this video, the focus is not going to be on suppressing emotion. It is going to be on building a structure where emotion becomes irrelevant to your decision-making process. That is how professionals operate, and that is what you need to develop. At the core of trading psychology is a single concept that defines everything else, and that concept is uncertainty. Trading is a probabilistic environment. There is no certainty in any individual outcome. No matter how strong your analysis is, no matter how clear your setup appears, the result of any single trade is unknown. Now pay close attention here. Most psychological mistakes in trading come from an inability to accept this uncertainty. Beginner traders subconsciously seek certainty. They want confirmation. They want reassurance. They want to feel confident that a trade will work before they take it. And because that certainty does not exist, they begin to compensate in destructive ways. They hesitate on valid trades. They exit early to protect small gains. They move stop losses to avoid being wrong, or they overcommit to positions they believe are certain. All of these behaviors stem from the same issue, discomfort with uncertainty. Professional traders think differently. They fully accept that any single trade can lose. They do not need to be right on each position. Their focus is on executing a process that produces a positive outcome over a series of trades. This shift in thinking is fundamental. Instead of asking, will this trade work? The question becomes, is this trade valid according to my system? That is a completely different mindset. When you operate in probabilities, you detach from individual outcomes. You stop needing each trade to succeed. And when that happens, your emotional intensity drops dramatically. You are no longer reacting to every tick, every fluctuation, every temporary move. You are simply executing a process. And that is where psychological stability begins. Now let's go deeper into one of the most destructive psychological patterns in trading, the need to be right. This is one of the biggest hidden drivers of poor performance, not because traders consciously think about it, but because it operates beneath the surface. In most areas of life, being right is rewarded. In education, in careers, in social environments. Correctness is associated with competence. So naturally, traders bring that mindset into the market. But in trading, that mindset is toxic, because trading is not about being right, it is about making money. And those are not the same thing. You can be right and still lose money if your risk is poorly managed. You can be wrong and still make money if your risk reward is structured correctly. This is a completely different paradigm. Now, this is critical. When your identity becomes tied to being right, your behavior changes. You hold on to losing trades longer than you should because closing them means admitting you were wrong. You cut winning trades too early because you want to secure the feeling of being right. You avoid taking trades that meet your criteria because you fear being wrong. Every one of these behaviors damages performance. Professional traders detach their identity from outcomes. A losing trade is not a failure. It's simply a result within a probabilistic system. It does not reflect intelligence, ability, or competence. This allows them to operate objectively. They can cut losses quickly without emotional resistance. They can let winners run without fear. They can execute consistently because their ego is not involved. If you remember one thing from this section, let it be this. Your goal is not to be right. Your goal is to execute correctly. Let's now address another major psychological trap, overtrading. This is where discipline begins to break down in a very visible way, and it often happens without the trader even realizing it. Overtrading is not just taking too many trades. It is taking trades that do not meet your defined criteria. It is acting out of boredom, frustration, impatience, or the desire to recover losses quickly. This is where most traders get it wrong. They believe overtrading is a frequency issue. In reality, it is a psychological issue. At its core, overtrading is driven by the need for action. Markets do not always provide opportunities. There are periods where the best decision is to do nothing, but doing nothing feels uncomfortable. It feels unproductive. It feels like missing out. So traders create opportunities that do not exist. Now pay close attention here. Every unnecessary trade increases your exposure to randomness, and randomness is where losses accumulate. Professional traders operate with a completely different mindset. They are selective. They understand that their edge only exists under specific conditions. Outside of those conditions, they have no advantage. So they wait. This patience is not passive. It is active discipline. It requires restraint, clarity, and confidence in your system. When a valid opportunity appears, they act decisively, but until then, they remain inactive. This is one of the hardest psychological skills to develop, because it goes against the natural urge to be constantly engaged. But once mastered, it becomes one of your biggest advantages. Because while most traders are losing money through unnecessary activity, you are preserving capital and waiting for high quality opportunities, and that difference compounds over time. Let's now move into one of the most misunderstood aspects of trading psychology, and that is discipline. Most traders talk about discipline as if it is a personality trait, something you either have or you do not, but that is not how it works. Discipline in trading is not about willpower, it is about structure. This is where most traders get it wrong. They rely on motivation to behave correctly. They tell themselves they will follow the rules, they will be patient, they will manage risk properly. But when pressure builds, motivation fades and behavior reverts. Professional traders do not rely on motivation. They build systems that enforce discipline automatically. For example, position sizing is not decided in the moment, it is predefined. Risk per trade is fixed. Stop loss placement follows a consistent logic. Trade criteria are clearly defined. There is no room for interpretation when it matters most. Now, this is critical. The more decisions you leave to real-time judgment, the more you expose yourself to emotional interference. Discipline is the result of reducing decision-making under pressure. If your process is clear, structured, and repeatable, discipline becomes a natural outcome. If your process is vague, flexible, and subjective, discipline becomes almost impossible. So instead of asking how to be more disciplined, the better question is this: how can you remove the need for discipline through structure? That shift changes everything. Because once your system is doing the heavy lifting, your role becomes execution, not decision making, and that is where consistency begins to form. Now let's talk about fear, because this is one of the most dominant emotions in trading, and it shows up in multiple ways. Fear of losing money, fear of missing out, fear of being wrong, fear of giving back profits. Each of these creates a different behavioral pattern, but they all originate from the same place: a perceived threat to your capital or your identity as a trader. Fear of losing money causes hesitation. You see a valid setup, but you delay entry. You wait for more confirmation, more reassurance, more certainty. By the time you act, the opportunity is gone, or the risk reward has deteriorated. Fear of being wrong leads to avoidance. You skip trades that meet your criteria because you do not want to experience a loss. Fear of giving back profits causes premature exits. You close trades too early, locking in small gains but never allowing larger winners to develop. Now pay close attention here. None of these behaviors are random. They are protective mechanisms. Your brain is trying to reduce discomfort, but in trading, those protective mechanisms work against you. Professional traders understand this. They do not try to eliminate fear. They manage it by controlling exposure. If your risk per trade is appropriate, if your position size is aligned with your tolerance, fear becomes manageable. If your risk is too high, fear becomes overwhelming. This is why risk management and psychology are directly connected. When risk is controlled, emotional intensity drops. When emotional intensity drops, decision quality improves. So the solution to fear is not confidence, it is controlled risk. Closely linked to fear is its counterpart, greed. And while fear often gets more attention, greed is just as destructive, if not more so. Greed does not always look obvious. It is not just about wanting more money. It appears in subtle ways that distort decision making, holding trades beyond your exit criteria because you want more profit, increasing position size after a win because you feel confident, taking lower quality setups because you want to accelerate growth. This is where most traders get it wrong. They associate greed with aggression, but often it shows up as justification. You tell yourself the market is strong. You convince yourself the trend will continue. You override your rules because the potential reward feels too good to ignore. Now, this is critical. Greed pushes you outside your edge. Your system is designed around specific conditions, specific entries, specific exits, specific risk parameters. When greed takes over, those boundaries are ignored. And once you step outside your system, you are no longer trading with an edge. You are gambling. Professional traders handle greed through constraint. They define their exits before entering a trade. They fix their position size. They do not increase risk based on emotion or recent performance. They understand that consistency comes from repetition of a proven process, not from occasional aggressive gains. So the goal is not to remove ambition. It is to ensure that ambition operates within structure, because without structure, ambition becomes risk. Let's now explore frustration, because this is the emotion that often leads to the most immediate damage. Frustration builds when expectations are not met. A series of losses, missed opportunities, trades that almost worked but failed at the last moment. Over time, this creates pressure, and that pressure demands release. This is where impulsive behavior begins. You take trades outside your plan, you increase position size to recover losses, you abandon your system because it feels like it is not working. Now pay close attention here. Frustration is not caused by losses. It is caused by a mismatch between expectations and reality. If you expect to win frequently, losses feel unacceptable. If you expect the market to behave in a certain way, deviations feel unfair. Professional traders operate with realistic expectations. They understand that losses are part of the process. They understand that not every valid trade will work. They understand that drawdowns are normal. Because of this, frustration is significantly reduced. But more importantly, they have protocols in place. If performance drops, they reduce size. If emotional intensity increases, they step away. If conditions are unclear, they stop trading. These are not emotional reactions, they are predefined responses, and this is the key point. Emotional stability is not about avoiding frustration. It is about having a structured response when it appears. That is what keeps performance intact over time. Now let's bring this together into a core principle that underpins professional trading psychology: process over outcome. This is one of the most important shifts you will ever make as a trader. Most traders focus on outcomes. Did the trade win or lose? How much money was made or lost? Was the decision correct in hindsight? But outcomes are noisy. They are influenced by randomness. A good trade can lose, a bad trade can win. If you judge your performance based on outcomes, your confidence will fluctuate constantly. You will feel good after wins, bad after losses, regardless of whether your execution was correct. Now this is critical. That creates instability. Professional traders focus on process. Did the trade meet criteria? Was risk managed correctly? Was execution aligned with the system? If the answer is yes, the trade is considered successful, regardless of the outcome. This creates consistency in evaluation. It removes emotional volatility linked to results. It allows continuous improvement based on behavior, not randomness. Over time, if your process has an edge, outcomes will align, but in the short term they will vary. So your job is not to control outcomes. That is impossible. Your job is to control execution, because execution is where your edge exists, and that is the only thing you can truly manage in trading. Let's now take this a step further. and talk about emotional consistency, because this is where most traders completely break down over time. It is relatively easy to stay disciplined after one or two trades. It is much harder to maintain that same level of control after a sequence of wins or losses. This is where psychological instability begins to compound. After a series of losses, confidence drops, doubt starts to creep in. You begin questioning your system, your decisions, your ability. This often leads to hesitation, missed trades, or abandoning your process entirely. On the other side, after a series of wins, overconfidence builds. You start to feel invincible. You believe you have figured the market out. This leads to increased risk, relaxed rules, and eventually unnecessary losses. Now pay close attention here. Both of these states are equally dangerous. Professional traders aim for emotional neutrality, not extreme confidence after wins, not extreme doubt after losses, just steady, controlled execution regardless of recent outcomes. This is achieved through one key principle: detachment from short-term results. Every trade is treated as one of many. It is not special. It does not define anything on its own. It is simply part of a larger sequence. This perspective stabilizes behavior, because when individual trades lose significance, emotional reactions reduce, and when emotional reactions reduce, consistency improves. So your goal is not to feel good after wins or bad after losses. Your goal is to remain stable in both scenarios. That is what allows long-term performance to develop. Now let's talk about confidence, because this is another area where traders often misunderstand what actually matters. Most people think confidence comes from winning. They believe that once they start making money consistently, confidence will naturally follow. But this is flawed. If your confidence is based on outcomes, it will always be unstable. A few losses and it disappears. A few wins and it spikes. This creates a constant emotional cycle that affects decision making. Professional traders build confidence differently. Their confidence comes from process. They know that their system has been tested. They understand its strengths and limitations. They have seen it perform over a large sample size. So when they take a trade, they are not relying on hope. They are relying on evidence. Now this is critical. Confidence based on evidence is stable. Confidence based on recent performance is fragile. This is why backtesting, journaling, and reviewing trades are so important. Not just for improving your system, but for reinforcing your belief in it. When you know that your edge works over time, you do not need each individual trade to validate you. You simply execute, and that changes your entire psychological state. Because instead of reacting to outcomes, you are trusting a proven process. That is real confidence in trading. Let's now address something that quietly destroys more traders than almost anything else: the illusion of control. In many professions, effort leads directly to results. The more you work, the better the outcome. The more you analyze, the more accurate you become. Trading does not work like that. You can do everything right and still lose money on a trade. You can follow your system perfectly and still experience a drawdown. This creates a disconnect between effort and outcome. Now, this is where most traders struggle. They believe that if they just analyze more, refine more, optimize more, they can eliminate losses. They chase perfection. They try to control every variable. But the market cannot be controlled. Now pay close attention here. The only thing you can control is your behavior. Professional traders accept this fully. They do not try to eliminate uncertainty. They do not try to force outcomes. They focus entirely on what they can control: their entries, their exits, their risk, their execution. Everything else is left to probability. This acceptance removes a huge amount of psychological pressure, because you are no longer trying to control something that cannot be controlled. Instead, you are focusing on executing your edge, as consistently as possible. And that is where long-term profitability comes from. So now let's talk about patience, because this is one of the most underestimated skills in trading. Most traders think patience simply means waiting for a trade, but it goes much deeper than that. Patience is the ability to do nothing when nothing should be done. This sounds simple, but in practice it is extremely difficult. Markets are constantly moving. There is always something happening. Prices are changing, narratives are evolving, opportunities seem to appear everywhere. This creates pressure to act. This is where most traders get it wrong. They equate activity with productivity, but in trading, inactivity is often the most productive decision. Professional traders understand that their edge only exists in specific conditions. Outside of those conditions, they have no advantage, so they wait, not passively, but deliberately. They are observing, analyzing, preparing, but they are not acting unless criteria are met. Now, this is critical. Every unnecessary trade reduces your overall performance because you are introducing randomness into your results. Patience protects your edge. It ensures that you are only engaging with the market when conditions are favorable, and over time this selectivity is what separates consistent traders from inconsistent ones. Because while others are constantly trading and eroding their capital, you are preserving it for high quality opportunities. Let's now bring everything together into one of the most important habits you can develop as a trader: self-awareness. Without self-awareness, none of this works. You need to understand how you behave under pressure, how you react to losses, how you respond to wins, what triggers impulsive decisions, what leads to hesitation. Because once you understand your patterns, you can begin to manage them. Now, this is where most traders fail. They do not track their behavior. They only track their results. They know how much they made or lost, but they do not know why they made the decisions they did. Professional traders treat psychology with the same level of importance as strategy. They journal their trades, not just the technical details, but their thoughts, their emotions, their reasoning. They review their behavior. They identify patterns. They refine their process. Over time, this builds a deep understanding of their own psychology. And that awareness allows them to intervene before mistakes occur. So instead of reacting after a loss, they recognize the early signs of poor decision making and adjust immediately. This is how control is developed, because ultimately, trading psychology is not about eliminating mistakes completely. That is unrealistic. It is about reducing the frequency and severity of those mistakes over time. And that starts with awareness. Let's now explore a concept that separates amateurs from professionals very quickly, and that is tolerance to drawdown. Every trading system, no matter how effective, will experience periods of losses. This is not a flaw, it is a mathematical certainty within any probabilistic framework. Now, this is where most traders get it wrong. They expect consistency in outcomes, not consistency in process. So when a drawdown occurs, they interpret it as failure. This triggers doubt. They start questioning their strategy. They begin making adjustments mid-sequence. They reduce size inconsistently or abandon the system entirely. But the issue is not the drawdown. The issue is the expectation. Professional traders understand that drawdowns are part of the distribution of outcomes. They anticipate them. They plan for them. They build their risk management around them. Now pay close attention here. If you are not prepared for drawdowns, you will not survive them. Preparation means knowing your historical performance, understanding your worst case scenarios, structuring your risk so that a losing streak does not cause emotional or financial damage. This creates stability, because when a drawdown occurs, it is not a surprise. It is an expected phase within a larger process, and when something is expected, it does not trigger the same emotional reaction. This allows you to continue executing your system without interruption. And that is what ensures long-term performance. Now let's talk about decision fatigue, because this is something that quietly erodes performance over time. Every decision you make throughout the day consumes mental energy, and trading requires high-quality decision-making under pressure. If you are constantly analyzing, constantly watching markets, constantly making small decisions, your mental clarity begins to decline. This is where mistakes start to appear. You take trades that are slightly outside your criteria. You miss details. You become reactive rather than structured. Now, this is critical. Poor decisions in trading are often not caused by lack of knowledge, but by reduced mental capacity in the moment. Professional traders manage this very carefully. They reduce unnecessary decisions. They have predefined routines. They trade specific sessions. They limit the amount of time spent actively engaging with the market. They understand that focus is a resource, and like any resource, it must be managed. So instead of being constantly involved, they are selectively engaged. They conserve mental energy for when it matters most. This ensures that when a high-quality opportunity appears, they are in the right state to execute it correctly. And that is a significant advantage. Let's now address something that many traders struggle with but rarely acknowledge properly: revenge trading. This is one of the fastest ways to destroy an account. Revenge trading occurs when a trader experiences a loss and immediately attempts to recover it, not through structured execution, but through emotional reaction. The mindset shifts from process to outcome. Instead of asking, "Is this a valid trade?" the question becomes, "How do I get my money back?" Now pay close attention here. That shift is extremely dangerous because it overrides your entire system. You increase position size, you take lower quality setups, you enter trades without proper confirmation, all in an attempt to reverse the loss quickly. But this behavior compounds losses. Professional traders never operate in recovery mode. They understand that losses are part of the process. There is nothing to recover in the short term. The only objective is to continue executing the system correctly. If emotional intensity is high, they step away. They do not trade until they are back in a neutral state. This is a rule, not a suggestion, because once you begin trading emotionally, your edge disappears. And without an edge, every trade becomes a risk without structure. Now let's explore the concept of identity in trading, because this plays a bigger role than most people realize. How you see yourself as a trader directly impacts how you behave. If you see yourself as someone who needs to win, you will protect your ego instead of your capital. If you see yourself as inconsistent, you will subconsciously reinforce that behavior. If you see yourself as disciplined, your actions will begin to align with that identity. Now, this is critical. Behavior follows identity. Professional traders develop a clear identity based on process, not outcomes. They see themselves as risk managers, as decision makers operating within a structured framework, as individuals who execute consistently regardless of external conditions. This identity shapes behavior because when you have a clear standard for how you operate, deviations become obvious. If you take an impulsive trade, it does not align with your identity. If you increase risk unnecessarily, it stands out immediately. This creates internal accountability. So instead of relying on external results to guide behavior, your identity becomes the reference point. And over time, this alignment between identity and action creates consistency. Now let's bring everything together into a powerful concept that underpins professional performance: emotional capital. Most traders focus entirely on financial capital, how much money is in the account, how much risk is being taken, how much profit is being made. But emotional capital is just as important. Emotional capital is your ability to make high quality decisions consistently. It is your mental clarity, your focus, your discipline, your resilience. And just like financial capital, it can be depleted. Every stressful trade, every impulsive decision, every emotional reaction consumes emotional capital. If it is not managed, it reaches a point where decision quality deteriorates significantly. Now pay close attention here. Once your emotional capital is depleted, even good opportunities will be executed poorly. Professional traders manage this actively. They take breaks when needed. They reduce risk during difficult periods. They step away after intense sessions. They protect their mental state as carefully as they protect their capital, because they understand that long-term performance depends on both. So the goal is not just to grow your account. It is to maintain the internal state required to operate effectively, because without that, even the best strategy will fail. Let's now move into how professional traders actually think at a deeper level, because this is where psychology transitions into decision-making frameworks. Professional traders do not think in terms of individual trades. They think in distributions. This is a critical shift. Instead of focusing on whether one trade wins or loses, they focus on how a series of trades will perform over time. Every position is simply one outcome within a larger sample. Now, pay close attention here. This removes emotional weight from any single decision. If you believe one trade defines your success, the pressure becomes enormous. You hesitate, you overanalyze, you interfere with execution. But if you understand that one trade is statistically insignificant within a sequence, you can act with clarity. This is how professionals maintain consistency. They are not attached to outcomes. They are committed to execution across a large number of trades. This allows them to think objectively. They can take a loss without emotional disruption because it is expected within the distribution. They can take a win without overconfidence because it does not change the long-term expectation. Everything is framed within probability, and once you begin to think this way, your entire psychological state stabilizes because you are no longer reacting to individual results. You are operating within a structured statistical framework. Now let's go deeper into decision making under uncertainty, because this is where professional thinking becomes very precise. Every trade involves incomplete information. You never have the full picture. You are making decisions based on probabilities, not certainties. Most traders struggle with this. They delay decisions, waiting for more confirmation, more clarity, more alignment. But in doing so, they often miss the opportunity entirely. Professional traders understand that waiting for certainty is not a strategy. It is avoidance. Now this is critical. Decisions must be made with incomplete information. The goal is not to eliminate uncertainty. The goal is to act despite it, using a structured framework. That framework defines what conditions must be met for a trade to be valid. Once those conditions are present, the decision is made. There is no hesitation. Because hesitation introduces inconsistency, and inconsistency destroys edge. So instead of asking, do I feel confident? The question becomes, does this meet my criteria? That is the only thing that matters. This approach removes emotion from the decision-making process. It replaces subjective judgment with objective rules. And that is how professionals operate consistently in uncertain environments. Let's now explore how professional traders interpret losses, because this is one of the clearest differences in mindset. Most traders view losses as negative events, something to avoid, something to minimize, something that reflects failure. But this interpretation is flawed. Professional traders categorize losses differently. There are good losses and bad losses. A good loss is a trade that followed the system perfectly but did not work. The execution was correct, the risk was controlled, the process was followed. A bad loss is a trade that violated rules. poor entry, incorrect sizing, emotional decision making. Now pay close attention here. Only bad losses are a problem. Good losses are necessary. They are part of the system functioning correctly. This distinction changes everything, because instead of trying to avoid losses entirely, you focus on eliminating bad losses. And that is achievable. You cannot control whether a valid trade wins or loses, but you can control whether you follow your process. Professional traders review their performance through this lens. They are not concerned with how many trades lost. They are concerned with how many trades were executed incorrectly. This creates a clear path for improvement, because once execution is consistent, results will follow over time. Now let's talk about adaptability, because while consistency is critical, rigidity can also be dangerous. Markets change, conditions evolve. What worked in one environment may not work in another. Most traders struggle to balance consistency with adaptability. They either change too quickly, constantly adjusting their system based on recent results, or they refuse to change at all, holding on to a strategy that is no longer effective. Professional traders operate differently. They separate execution from development. Execution is consistent. When trading, they follow their system without deviation. Development is structured. Outside of live trading, they review performance, analyze data, and make adjustments if necessary. Now, this is critical. Changes are not made in the moment. They are made based on evidence. This prevents emotional decision-making from influencing strategy. It ensures that adjustments are logical, not reactive. So when conditions shift, professionals adapt, but they do so in a controlled, structured way. This allows them to maintain consistency while still evolving over time. And that balance is essential for long-term success. Let's now bring all of this into a practical framework for how professional traders approach each trading day. It starts before the market even opens. There is a clear plan. What conditions are being monitored? What scenarios are valid? What risks are acceptable? This creates clarity. When the market opens, there is no need to figure things out in real time. The framework is already in place. Now pay close attention here. Clarity reduces emotional interference, because uncertainty in your process leads to uncertainty in your decisions. During the trading session, execution is simple. Either conditions are met or they are not. If they are, the trade is taken. If they are not, nothing is done. There is no forcing, no chasing, no reacting. After the session, there is review, not just of outcomes, but of execution. Were rules followed? Was risk managed correctly? Were decisions aligned with the system? This creates a feedback loop. Over time, this loop refines both strategy and psychology, because you are constantly reinforcing correct behavior and identifying areas for improvement. And that is how professionals operate, not through emotion, not through reaction, but through structured, repeatable processes applied consistently over time. Let's now move into practical application, because understanding psychology is one thing, but applying it in real trading conditions is where transformation actually happens. So here is how this works in practice. Before entering any trade, there must be a clear checklist. Not a vague idea, but a defined set of conditions that must be met. If those conditions are not present, the trade does not exist. This removes interpretation. Now this is critical. The decision is made before the moment of pressure, not during it. Once a trade is identified, risk is defined immediately. Position size, stop loss, and overall exposure are calculated before entry. There is no adjustment after the fact. This creates certainty in risk, even when there is uncertainty in outcome. As the trade progresses, your role is not to manage every movement. Your role is to follow the plan. If your system defines an exit, you take it. If the stop is hit, you accept it. If the target is reached, you execute. No interference. Now pay close attention here. Most psychological damage occurs after entry, not before it. This is where traders begin second guessing, adjusting, reacting. By having a predefined structure, you remove the need to make decisions under pressure, and that is what keeps execution consistent. Now let's build a simple but powerful daily routine that reinforces everything you have learned so far. The day begins with preparation. You review your plan, you understand what conditions you are looking for, you define what a valid trade looks like. This creates focus. During the trading session, your job is observation and execution, nothing more. You are not searching for trades, you are waiting for them. This is where discipline is applied. If nothing meets your criteria, you do nothing. That is a successful day. Now this is critical. Success is not defined by activity, it is defined by correct behavior. After the session you review, not just what happened in the market, but what happened in your decision making. Did you follow your rules? Did you hesitate? Did you act impulsively? This builds awareness, and over time this routine creates consistency because you are reinforcing the same behaviors every day. This is how professional habits are formed, not through occasional effort, but through repeated structured action. Let's now address how to handle real-time pressure, because this is where most traders lose control. When you are in a trade, the market is moving, your position is fluctuating, and emotions begin to rise. This is where your preparation is tested. Now pay close attention here. You do not rise to the level of your expectations. You fall to the level of your preparation. If your process is not clear, you will react, you will move stops, you will exit early, you will override your system. But if your process is defined, there is nothing to decide. You already know what to do. Professional traders rely on this heavily. They do not think in the moment, they execute what has already been planned. If emotional intensity increases, they reduce exposure. If clarity drops, they step away. These are predefined responses, and that is the key point. You must decide in advance how you will behave under pressure, because if you wait until the moment, emotion will take over. Structure removes that risk, and that is what allows you to operate effectively in real-time conditions. Now let's bring everything together and reinforce the core principles that define trading psychology at a professional level. First, trading is a psychological discipline as much as it is a technical one. Without control over your behavior, no strategy will produce consistent results. Second, uncertainty is unavoidable. You are operating in probabilities, not certainties. Once you accept this, emotional pressure reduces significantly. Third, process is everything. Outcomes are variable, but execution is controllable. Focus on executing correctly, not on being right. Fourth, risk management and psychology are directly linked. Controlled risk leads to controlled emotions, which leads to better decisions. Fifth, consistency is built through structure. Predefined rules, routines, and frameworks remove emotional interference. And finally, self-awareness is the foundation. Understanding your behavior allows you to manage it effectively. Now, this is critical. None of this is theoretical. These are the principles that professional traders operate by every day. And once you internalize them, your entire approach to trading changes. As we close this video, it is important to understand what this really takes. Trading psychology is not something you fix once, it is something you manage continuously. There will be days where you execute perfectly. There will be days where you make mistakes. That is part of the process. The goal is not perfection. The goal is progression. Every trade, every session, every review is an opportunity to refine your behavior. Over time, those small improvements compound, and this is where most traders underestimate the process. They look for breakthroughs, but success in trading comes from incremental improvement applied consistently over long periods. So focus on your process, protect your discipline, manage your risk, build your awareness, because that is what creates long-term performance. And if you commit to that, not just occasionally, but every single day, you put yourself in a position that most traders never reach. If you found this valuable, make sure to like, comment, and share it with others who are serious about improving their trading. And if you want to go deeper into institutional level trading frameworks, subscribe to the channel so you do not miss what comes next.